If you look at a typical American middle-class family from the outside, it projects this image of, total stability.
Right. You see the house in the suburbs, the 2 cars, the weekend soccer games.
Exactly. But for today's deep dive into what's being called the quiet crisis, we're looking at a stack of recent economic reports and consumer debt studies that paint a starkly different reality. We're really exploring the unseen financial reality facing middle-class parents right now.
Because if you look inside that same house at, say, 11:30 p.m. on a Tuesday, you don't see stability. You see a father illuminated by the glow of a laptop, just silently agonizing over a stack of bills.
Or a mother at the grocery store, right?
Yeah.
Calculating prices in her head before she even drops a simple box of cereal into the cart.
Yeah, exactly.
So, whether you are a parent feeling this exact pressure or you just want to understand this modern financial squeeze, our mission today is to break down the mechanics and, honestly, the heavy emotional weight of keeping a family afloat.
And the root cause driving this anxiety is really a massive disconnect. Our sources highlight this core conflict where median salaries are, well, they're relatively stagnant.
While fixed necessities like mortgages, insurance, groceries, childcare are just surging.
Right. And the distinction we need to make here to really understand this crisis is the difference between income and cash flow.
Okay, break that down because society kind of teaches us that a respectable income means financial security, right?
Yeah, it does. But income is just a yearly number on your tax return. Cash flow, though, is the mechanical timing of money moving in and out of your bank account on a daily basis.
I see. So even if you make what looks like a really solid middle-class salary, if 90% of that is locked up in rigid, fixed expenses on the first of the month.
Your cash flow is functionally zero,
Wow.
which means you have literally no shock absorbers. When cash flow is that tight, a minor emergency, like needing new brake pads or, an unexpected trip to urgent care, it doesn't just stretch the
It
budget,
breaks it completely.
it breaks it. And when the budget breaks, families are forced to bridge that gap with debt. This is where the math turns into pure emotional weight.
Right. People get pulled into this cycle of minimum credit card payments or EMIs, which are equated monthly installments.
Yeah, which basically means breaking a large purchase into fixed monthly payments with the interest just baked right in.
And those EMIs and minimum payments, they create this dangerous illusion of affordability, don't they?
They really do. You're covering the minimums, so it feels like you're managing. But mathematically, paying only the minimum on a high-interest credit card is, well, it's like trying to empty a swimming pool with a teacup while someone else is leaving the hose running.
What is a terrifying visual? But it's true. The principal balance barely shrinks because the interest keeps filling it back up.
Exactly. Which bleeds directly into the emotional fallout. It's those hushed arguments over money after the kids are asleep.
Yeah.
It's the pain of hiding that struggle. Trying to shield your child from your own financial anxiety when they ask for something you simply can't afford.
And it feels like a systemic gap here, too. We place young adults into a highly complex, honestly predatory credit system with zero financial education in schools.
Right, and then blame them for not knowing the rules of a game that's completely stacked against them.
But hold on, because the solutions I see in these financial studies, they always point to quote-unquote smart planning, setting up emergency funds, strict budgeting. I have to push back on that.
Okay, how so?
Well, if a parent's cash flow is already devoured by fixed expenses, telling them to just save an emergency fund feels disconnected from reality. How do you budget your way out of zero wiggle room?
That is a very fair point. And if your cash flow is truly at zero, skipping a few coffees won't save you.
Exactly.
The research actually suggests a structural reset is needed, rather than just cutting coupons. Escaping that cycle usually requires a painful temporary downgrade in fixed costs.
Like trading in a financed car for a cheaper used one. Yeah, or aggressively restructuring your debt to free up even a tiny margin of cash flow. Because once you create that tiny margin, you can start doing things like systematic investment plans or SIPs.
Right, so basically automating a microtransfer of money into an investment or savings account the second your paycheck hits, like before you even have a chance to spend it.
Yes, that automation is the mechanical key. It removes the daily emotional fatigue of having to decide to save.
Because you're already exhausted from agonizing over the bills.
Exactly. It's a slow, grueling process to regain control, but those small, automated structural changes eventually compound. And that's what pulls you out of the debt cycle.
It's really about slowly buying back your peace of mind so that 11:30 p.m. on a Tuesday is actually used for sleeping.
Absolutely.
Well, we want to leave you with one final thought to mull over today. If you had to explain your current relationship with money to a child without using any numbers or math, what story would you be telling them?